Just while I'm sort of picking on my first victim for a question, John, just to you, Neil even, sorry, I get my names right. When just looking at your graph, you've got the, if you're in the green, so you're a low-cost producer, is it a question of once a low-cost producer, always a low-cost producer, or are there factors that mean you rise and above the green line?
No, but it's all about, so if you've got there in the first instance, you should be able to stay there, but it's about keeping on top of the game, keeping a focus on it. You just can't get lazy in that situation. Just keep focus on attention to detail. You know, you've already had the skills to get there. Just keep building on those to make sure you stay there.
And that takes incredible discipline, Neil.
Absolutely.
We saw that when we had the price spikes in wheat in 2011 and 2009. I think there was a lot of luxury spend crept back into arable farming. And so the discipline you need to make sure you really manage those costs when actually suddenly there is a bit of cash in the bank, or potentially you're making a bit of money.
Yep.
It's really difficult.
Yep. Oh no, I would agree with that. But I think, and look, I think when there is, when that green line producer is getting a really good price and there is cash in there to go for luxury, if it's luxury stuff that can then make a difference to the business in the long term. So if it's a longer term investment that can help the business go forward, then well, actually, why not? But if it's just maybe buying, a bigger tractor to do the job, well, maybe that's not the way ahead, Tom, but who knows?
Okay, so money isn't the root of all evil. I've just had a nod from, I think it's Mr. Cardell down here, so Chris.
Thank you, William. Chris Cardell, Chairman of NFU Tenants Forum. And probably after this morning's quite successful NFU Tenants Conference, I didn't want to mention tenants again, actually, but I think what it highlights is, and I think Tom did as well, with the contract farming, we have a very varied land tenure system in this country. And I'm sort of asking a slight question of all of the panel how they see that helping us going forward, or whether it'll be a hindrance. So sort of, Rohit, you mentioned put up a list of some alternative things that we could look at. Which of those do you think will be the best for our varied and exciting land tenure system? I know we've had some discussions around the insurance scheme. Probably we're on different planes on that one. But also on Tom, you mentioned there about the flexibility that gives you. Is that going to be important going forward, or a hindrance on that? And John, we hear about the costs of things. Do you see those with slightly more pressure of the tenanted sector being slightly ahead of the cost gain, or are we trailing? Is it something that we can all share between ourselves there? Richard, obviously the succession is going to be around to you. How do you see us getting, I noticed your list you put up there, but I was a little bit disappointed you had nothing on there. How do we get the next generation into the industry? Surely they're going to be a key part of helping to drive the thing. And Neil, a little bit of a challenge for you as well. The one thing that we get from a lot of our youngsters that want to get into this industry is that they can't actually get the borrowings, because all of you chaps from all of the companies tell us that it's really doubtful economics to lend below 50,000, and to get an agricultural manager, sometimes a lot of the firms were looking at 100, even 200,000. But actually, for a youngster getting in, they only may want 10 grand just to take on a grass keep down the road.
Yep.
Take that mic off you. Thank you very much. I won't have anything to do. I mean, he's asked the questions of all the panels. So, Rohit, do you want to start first?
Yeah, sure.
Yep.
Thanks for your question. So, yeah, you're absolutely right. It's a very complicated picture when you look at the varied land tenure system. But I think one of the areas we are looking at is how the productivity element can really help tenant farmers. So it's about how you target benefits towards the active farmer. And that is around how you tie up advisory services to help farmers identify benefits on farm with grants and loans. And so one of the areas we are looking at is loan guarantee schemes, for example, to help farmers who don't have the collateral to borrow to have a guarantee. So in essence, the way it works, and it works in a lot of other industries that are up and coming, is that you have government who provide a guarantee, and then the banks lend off the back of it. And they're able to lend because the government acts as a guarantor. And it's a bit of a win-win. There's actually, because default rates are so low in the industry, actually, it doesn't take any money out of the public purse. It means farmers can borrow and invest, and it can make them a lot more efficient and productive on farm. And that's a great way of targeting tenant farmers or active farmers.
Okay, we'll go next.
I think in the UK, the contract farming really has come about because of the benefits of remaining an active farmer. And so I think we really need to look at that system, because at the moment, if you sign long-term tenancies, there can be capital problems with that in England. But actually in Ireland, if you sign tenancies over 10 years, you can get tax relief on that. So we need to start looking at the different mechanisms which could mobilise land and change the structures we're farming under. Because 3-year contract farming agreements really are no good for anybody. You know, 5 years, 10 years, it's much more realistic to be investing in that land for the long term, but also for the benefit of your business, not just the landowner who you're looking after the land for. So I think we really do need to look at different schemes that are available. The Irish do have an interesting model, but also I think it's really important that if land is let out, that we need to try and retain some of those benefits of being an active farmer, so that we're not just sort of doing it through the back door.
Yeah, on the cost of production, there's obviously a very wide range of costs there across all the different sectors. Like going to what Neil was going through there, understanding what your cost base is extremely important before looking at using risk management strategies to fix prices. You don't want to be in a situation where you're basically fixing yourself into a loss or you know, or even a worse scenario. So having a very clear understanding of where your cost base is, where your potential margin then can be locked in. That's critical.
Yeah, no, well, thank you very much, Chris. Obviously, don't want to take away the good work that you're doing for the Tenants Forum as well, and we obviously work very closely together. It's like a lot of these things. There's not one golden bullet for everything, is there? It's a multi-approach which we need to focus on. I was at the Young Farmers Council weekend at the weekend, and in my view, I think Young Farmers is vibrant. There's 24,500 young farmers in the UK, well, in England, sorry, and there's about 6,000 in Wales as well. So, and the ones that I meet, I think, are very progressive and very forward-thinking and want to get involved. I think we have to be careful. You don't always have to own that land as well, or you don't always have to be in charge of that farm. I think, like I say, there's other ways of getting on the ladder. I was in New Zealand last year, and they have a lot of the share milking as well, and I think there's opportunities that way, or even like poultry, you can be, you profit sharing through the management as well. So I think there's lots of different ways of getting a step on the ladder. I know you're working on the Fresh Start partnership as well, which I think has got a lot of potential, but it'd be good if government could get behind that as well. And what that does, that matches people. And I was sat at breakfast this morning with a man who's a very big farmer, but he hasn't got a son who wants to take on the farm, so he says he'll retire at some point. So what it does, it matches somebody in that position with a young farmer who wants to get a step on the ladder, and hopefully creates an opportunity there. It's a business arrangement, and this is business at the end of the day. But I know the Irish are way ahead of us at the moment of doing that, and that's why I highlighted earlier with the Young Farmer Scheme, and we do need the government to get behind us in those situations as well, please.
Thanks for the question, Chris. I think I would agree with you, Richard. We've seen recently a lot more activity from youngsters doing different things to get into the industry. So joint ventures, I suppose, getting away from that traditional looking for a tenancy or a grass keep, as you called it. So different joint ventures, and I think as a whole industry, not just the youth, we need to be more open-minded on that, particularly using your example of where maybe the next generation isn't coming home, but the existing generation will like to see that farm kept going. There's other ways and means there to keep that moving. Specifically on your question around about finance, and just to come back to something Rohit said, the loan guarantee scheme is actually open to farming just now, but there are exceptions around about the de minimis rules. So some young farmers can get access to that, but it just depends how much they need and how long they need it for. And I think access for new entrants is difficult. It's always going to be difficult, but actually it doesn't matter whether you're a new entrant or an existing business. It actually comes down to coming in with the right skills, being able to demonstrate that you can get in and make a go of this business. And unfortunately, it's coming with some form of capital. It doesn't necessarily need to be collateral or security, but it's some form of capital to get you going. Banks are going to struggle to do, high percentages of finance. 100% finance for a new starter is very, very difficult for us to do. And on your agriculture manager front, you're right. Smaller levels of borrowing, it's difficult for us as a bank to justify having our relationship manager purely for a small overdraft. But I would say that if the young farmer is up for it and forward looking, they should be picking up the phone to me or one of my regional colleagues to have a chat about it. We might not be their direct relationship manager, but they shouldn't be shy of picking up the phone and having a wider chat with us about what they want to do and what they want to achieve, and whether there's anything other than just giving them the money that we can help them with.
Okay. Who in the room would categorise themselves as a young farmer and a person that would want to take over from the retired farmer that Neil's just, or I'm not sure, Richard just mentioned? So show of hands, who's in that position? Okay, so there's a lot of potential there for the banks to be talking to these people, and it's great to see that there's actually a lot of people want to go farming. Hoorah. Now, I've got another question. You look sort of familiar to me. But anyway, Clive, Julian, can you pass that gentleman to your right,
Hi, thanks. It was really to Neil. Philip Ward from Cornwall. It's really about, with Neil, with a low cost of production. In some circumstances, quite frequently, lower cost of production equates to lower yields. And so can you talk a bit about the difference that makes? So some people are choosing to have a higher cost of production, say in a dairy system where you feed in a bit more, so you're getting a lower margin per litre, but you're producing more litres, and you seem to have missed that bit out on your graph.
Well, some of our customers with, if you use the dairy example, some of our customers with the highest costs have the lowest cost of production because they're exceptionally efficient and high productivity. So it's what I'm putting up there is not about cost cutting. It's about getting the maximum benefit for your business you can from incurring that cost. So it's not about necessarily running a low-cost system or having a cheap system or just cutting costs, and I certainly would not advocate that for exactly the reasons you laid out there, because it can, if you're not cutting costs in the right area and you're just cutting it across the board, then it can be detrimental to the business. So that's where I would draw a slight distinction from that. Where I would find the low cost of production businesses tends to be they make the gains in productivity rather necessarily than cost cutting.
I mean, if I can just add to that, is there specific sectors that are performing better than others, and maybe some that need a bit of help?
I think that probably the one that needs the most guidance at the moment is probably red meat. Okay. Just in terms of guidance, just in terms of being able to understand where they are, what the production are. We still talk a lot about per head, but if you go to other parts of the world, they start talking about kilograms a hectare and things like that. So it's a benchmarking system that's reliable around about that people can start to look at and understand where they are.
Thank you.
Question specifically for John, I think. I don't want to appear cynical, because that will never do at a farmers' conference. But the use of futures is increasing, and so is volatility. Futures are making volatility worse. €3,600 for butter before or after Christmas, €5,200 now. It's insane. Sellers are, as a result, just selling hand to mouth, month at a time. Futures are not the tail wagging the market dog. Futures are the flea on the end of the tail of the dog. And the more volatility we get, the more risky futures become because of the margin calls. Somehow, we got to get off this roller coaster, which is being exacerbated by the futures markets. Comment, please.
Can you say who you are, sir?
Chris Walkland, journalist.
From what?
Quite a lot, freelance, quite a lot of dairy mags.
Thank you. Okay. John, I think that's over to you.
I suppose first, I wouldn't agree with the main component there that futures are driving the market. We live in a more volatile world now. We live in a more connected world. Stocks are lower. We don't have a situation like back in the 90s and early 2000s where we have big intervention stocks to lean back on when there's a shortage, or that we do have on the skim milk powder but not on the butter, which is where your main comment is there right now. Butter prices, yes, I agree, they have been absolute roller coaster in the last year and a half. But a lot of that is due to what's happening on the global markets. Cheese demand, especially into Southeast Asia, has been extremely robust since the end of last year, and that has been driving the demand for milk and pulling milk away from producers producing skim milk powder and butter. I don't see futures driving the market per se. I see the futures markets responding to what's happening in the physical market, and I also see the futures markets providing the transparency, showing people what is actually trading in the market at a point in time. Like this whole scenario could be happening in total absence of futures markets. We did in 2008. Butter prices went from under 24 or under 2,500 euros a ton up as high as 4,500 euros a ton and back down again. This is pre any futures markets existing. So I don't agree with the point that futures are driving the markets per se. I see it as a response, them responding to what's happening on the physical market, to the supply and demand factors there. And I see farmers and I see end users and the whole supply chain using futures markets to try and manage the volatility that is there and that is going to continue to be there.
John, in the grains market, when we've seen the real volatility in the marketplace, it does appear that the futures market drives the top higher or the bottom lower, just because of the amount of open lots, the amount of people that are really gambling on that marketplace. So I think the absolute extremes of the volatility do seem to extend because of that, the people gambling on that market.
And there is definitely arguments to be had, especially in more mature markets like the grains and oil seeds and other kind of moving into oil, etc. But you have, I suppose, to understand, especially in the dairy market at the moment, there is very, very little what we call institutional investors. It is all hedgers, either buy side or sell side. People are hedging their price risk. They're not in there to try and benefit massively from those big price moves. You look at grains, especially say looking at Chicago and Paris, there's a lot of what we call institutional investors, basically funds that are looking to benefit from price moves in the market. That doesn't exist on dairy for the most part.
So the dairy, it's all physical users or sellers?
The vast majority of the interaction on the dairy market is physical users, yeah. Okay. They'll have physical exposure, either producers, end users, traders, etc. Yeah.
Yeah, and just to add to that, I mean, the NFU's position on this is futures aren't a silver bullet. They're actually a means to provide a choice of contracts in line with a farmer's risk appetite. So effectively, if you're a farmer who wants to hedge or lock in a price that's suitable for your business and in line with your margin, you should be given some of the options to do that. And that's the idea with a futures contract. It's the same way we use if you have a mortgage for your house and you lock in a 5-year fixed interest rate. You're not physically trading on interest rate swaps, but you are locking in because that's right for you and your budget. And that's the idea. It's about having the option to be able to lock in a price that's right for you. We do have Rob in the audience from Muller. I'm not sure. Would you like to comment on this as someone who's offering one of these solutions?
So yeah, Rob Hutchison, Agriculture Director at Muller. So last summer we launched a futures offer for our farmers. I think it's fair to say it is absolutely aimed at those farmers that know their margin and therefore are willing to maybe lock in that price. It's fair to say that the farmers that locked in sort of August, September when we first launched it, their price is around sort of 28, 30p. are happy with the scheme, but there's no doubt that there's been a big drop-off since September, and those that didn't lock in are seeing lower prices. But it's fair to say, as Chris mentioned, we've seen a big recovery really since in the last 2-3 weeks, so the prices are coming back up. So I think it's one that we need to judge over the cycle. But for me, it's just about giving farmers choice on, if they know their margin, when can they lock in their price, and giving them an option to do so, which up until now in the dairy sector in particular has not been possible.
Yeah, so it's about moving away from the take it or leave it on the price and being able to have some options in line with your business needs. That's the idea. So.
Just to put it in context, of the farmers you've got on your books, total number versus how many have gone for the futures option with you?
We've got just over 130 farmers have signed up to the option, so out of around about 1,800. We didn't open it to all farmers. We opened it to Muller Direct farmers only. But in terms of volume terms, it's pretty small. It's probably only about 2-3% of our total volume.
I know Tom Hind, Chief Strategy Officer from HCB, just wants to come in on this. No? It's a question. Oh, he can't. There's a gentleman who is before you, I'm afraid. I thought you were going to comment on this issue. Right, okay, so we're going to move across to cost of production. So, name and who you are.
Andrew Ward, arable farmer from Lincolnshire. Mainly, Neil, I think you can maybe answer this one, and maybe one of the others, save going on too long. Looking at cost of production, I think it's probably common knowledge that the biggest issue we've got is that a lot of farmers don't know what their actual costs are. And I've seen some figures recently where it was only 20% of UK farmers know what their actual cost of production is. And I think that's the biggest issue. And in my situation, luckily, I'm one of the 20%, and I've got 26 items that I put into my cost of production. And one of those is simply a telephone as well, putting that towards the cost. But just wondering, of you at the front, do you think it still is a big issue, and how do you think we can get around that to make farmers more aware of what the costs are? Because as an industry, I think it's not good enough that if there's only 20%, no, we need to improve that.
Yeah, okay, thanks, Andrew. I haven't measured it, but your 20% figure would not surprise me at all. I think from our perspective at the bank, it's just about continuing to encourage that conversation. And generally speaking, I would say that when our managers are out on the ground, we're asking a lot about cost structures of businesses. I think the extension of what you say is that it's important that the owner or the manager knows the cost base of that business rather than necessarily the consultant that might help them. I think in too many cases, we ask a question of the owner of the business, and they turn and look at the consultant and go, well, can you answer that? The reality is we're looking for the farmer to own it. So from our perspective, it's that continual encouragement to get to know the cost base there, particularly when they're coming and asking for something else.
When we were doing the Monitor Farm programme, it was, it's one of those subjects that no farmers like to talk about, is the cost of production, exactly what their costs are. But actually, once we all opened up, it was amazing the discussion that developed and the greater understanding that you gained about somebody else's business, but about how you could implement that on your business. So one of our growers in our group had a much lower fungicide cost than anybody else in the group. It actually happened because he farms on the coast and he's got very low disease pressure. But it's only when you start understanding those detailed costs that you can really start working out exactly what's going on. But the openness that farmers suddenly had was just amazing when we were really talking about those figures in depth, and it was a great thing to be part of.
Yeah, and as Secretary of the Next Generation Forum, that's one of the things I do as part of my role. One of the key things that have come out of the Next Generation is that they go to agricultural college when they're 20-odd and they learn some budgeting skills and financial skills and all the rest of it. But by the time they take over the books, it's usually a good 10, 15 years later, and they've generally a bit rusty in terms of how to apply those skills. So a lot of the younger farmers are saying, actually, we need the resources to be able to actually refresh ourselves in terms of how we can best go about managing our finances. And it's something as simple as that, actually. Where do you have the support to build those business skills? And when I put those graphs up about the difference between the top 25% and 50%, so Farm Business Survey have done some analysis on this, say actually what was the difference between the different businesses, and the key drivers for across the sectors was about around management accounting techniques and using software, financial software to be able to manage your business, and that's what's helping to drive some of that better decision making. So we think in the advisory side there's a lot more to be done in that area.
Okay, I'll just bring Tom Hind in, if I may, not for a question, Tom, but for a comment. Obviously the B word, benchmarking, how's it going with AHTV? I think you've taken on the mantle of trying to get that out there, so can you comment on that?
I can, but I will also take the liberty of asking a question as well, because since you've given me the microphone, I feel that I can. I mean, look, I'm not a farmer, so I'm always really mindful in what I say in these occasions, but my experience over the last 20 years tells me the same as Andrew, that understanding costs of production is pivotal to at least understanding whether you're profitable or not. Good farmers do that, the best benchmark themselves against others. We can provide some of the tools and equipment that enable producers to understand their cost of production, but the starting point is having that willingness and enthusiasm to want to do it, and I'll bring that back in relation to the question. I think at this stage you'd be probably, I guess, most relevant to plug a couple of things. I mean, the first is benchmarking. We know we're not the only people involved in that space. A number of other businesses, farm business consultancies in particular, in the dairy sector offer benchmarking tools and services, and that's important. But our recently launched Farm Bench tool is available. It's there now for the industry to use. It provides an opportunity not only to measure cost of production, but also to benchmark against other producers. The question is really related to Neil's premise, which is about the resilience of the industry. So I tend to agree with the analysis that the industry has been phenomenally resilient, if you at least measured in terms of its ability to increase its borrowing year on year on year, even through the bad times of the financial crisis. Yeah, I just wonder how true that might well be as the safety net of direct support is progressively removed over the course of the next few years, given just how important that is both to farm business income and also to asset values. And the question really for the whole of the panel is, what can farming businesses do now to start preparing for that?
Is everybody looking at me? Thanks, Tom. Yeah, look, I think if you think of what this industry's come through, even just this century, you know, foot and mouth, all of these kind of things, you know, actually, dairy crises, you know, record lows and wheat price, stuff like that. It's been resilient. Okay, I get the fact that there has been a subsidy system there to support, and there has been market intervention to help support that. What I would also add is, you know, we talk about farm borrowing and things like that, but there are probably, you know, if I worked in a rough rule of thumb, half of farmers don't actually borrow any money. So they don't have necessarily debt pressure. So actually in a lot of these instances, if we get through Brexit and, you know, there's changes to subsidy systems and there's tariffs come into play, however that might pan out, actually, I think from a banking perspective, we've had great experience of resilience. And for those owners that want to go on, and they might need to change their business, they probably will have to change their business going forward in those scenarios. I expect we would want to give them the opportunity as a customer to do that. And in a lot of those circumstances, actually, they're not that heavily borrowed. Borrowing is not necessarily a big pressure, and you know, we can help them get to a point where they can have a cash generative business again. It might take a few years to get there, but if we know the direction of travel and we trust them, we'll get down that route. So I don't think, from my perspective, bank support's not going to change overnight if this is a cliff edge.
That's good. That's what Barclays said at the business symposium the NFU held about 3 weeks ago.
Yeah. I mean, we are farming and we are borrowing money, so I'm very aware of managing the business and servicing the loans that we've got. Very aware of interest rates at the moment. I mean, the lowest they've ever been. I spoke earlier how when the farm was bought, base rate was 15%. So I think we need to know when to lock into those fixed rates, those interest rates as well. You've seen that we've invested in a strip tillage corn drawer, we've invested in a cattle handling system, but our bank manager actually came around for our annual review last Friday as well. We are going to be investing in the diversification, there's probably a bit more this next couple of years, probably just to give us a bit of stability for the depending on what's going to happen with direct payments. So it's more of a portfolio, managing the business as a portfolio going forward, really.
But there is an issue here around the important role that direct support plays now in terms of managing the cash flow squeeze when there is a downturn in commodity markets. And it is difficult to see what will replace that in the new regime or the new environment. And that's something we're working very hard at to understand. And I think it's sometimes overlooked when we look at overall farm business income. There will need to be new measures in place to help with those cash flow issues, given the volatility in the markets. And it will have to be some form of, as I talked earlier about systemic risk, some of that will have to be some sort of structure of direct support or agri-environment schemes to help farmers get that resilient cash flow year on year. So.
Our home business, Tom, is pretty, we're not really very reliant on our BPS at all, but my concern more is for our contract farming business, because at the moment the support payment goes as a sort of form of rent, if you like. But at what point are those landowners going to turn around and say, well, actually the returns now are so poor, there's no point in us having the land farmed? So if they're getting £180 an acre in a good year at the moment, and suddenly that goes down to £100 an acre, or it goes down to £70 an acre, what pressure is that eventually going to put on the land market? Because we can't, our business, we can't cut any more cost out of our business. So we can't take any of that pain effectively. So it's got to be the landowner that we're farming for there who reduces their income. But then they've got this asset, which at the moment is an incredibly valuable asset. And is there going to be people looking at it saying, well, I mean, I guess in Essex we're reasonably lucky that we've got a lot of diversified income. But if you're in a part of the country where you haven't got access to that diversified income, is there going to be a lot of land come on the market?
Very interesting point. But I do have a question here which I hope is going to lead us into the volatility section. So name and, well, not number, because that would be rude.
Thank you very much. Philip Holhead, Norbret Genetics, but I'm lucky enough also to own 300 Holstein dairy cows on a very wet farm in Lancashire. I think we're missing one point here that it's as much a question as a point, I guess, and I hope you don't mind me intervening. The volatility point we grappled with quite a number of years ago, but with a lot of help through integration. Tesco invited us to join them as a dairy farmer, and along with, I think there's around 700 other dairy farmers in the UK, to join their group and grow and learn from each other with a major supermarket. From that, our business has grown and strengthened and integrated in a true fashion, and the integration hasn't finished, I don't believe, because there'll be much more to come. We work around now a QVIS model, quality, value, innovation and service, which drives efficiencies for everyone, the farmer. It gives passion and enthusiasm for my team and my staff. It hopefully delivers for Tesco, and as they integrate more with the Booker business, hopefully there'll be more business for everybody further down the chain. So the volatility, I actually took the very stupid business decision when I look back to join the Arla Co-op and come out of that security with Tesco. And unfortunately, I ended up as a business down at 18.3p a litre for my milk 2 years ago in a supposedly farmer-owned environment. So there's a few points there, but I think genuine partnerships, integration, and a model that is genuine and forceful and powerful for everyone, from farm worker to farm owner to supply processor, and then right through to consumer, to deliver an environmentally profitable model right through, is surely a better way to go.
So there's the question, who wants to...
Yeah, I mean, absolutely. There's a lot of talk about the role of integration going forward. So, a lot of people look at the poultry sector, or they look at aligned contracts in dairy and say, why can't we do this for everyone? And the reality of it is that if there's not the commercial incentive for, say if you're a commodity producer, you produce skim milk powder or something, there isn't that pressure from the consumer around provenance, and it's a very different market. And given that roughly 50% of our liquid milk goes into that market, not everyone at the moment has a liberty of joining an aligned contract. So yes, absolutely, it will be about more collaboration. It's about working more closely with your milk buyer. But I think the reality of it is that it's not an option that's available for the whole industry. It's not an industry-wide solution, and that's just the reality of the commodity markets that we operate in.
I think it's a challenge across the sector, Philip, because some people actually quite like volatility. And that's a challenge we've got. whether we like it or not. You know, you might sit in the camp where you like that integrated approach. It's maybe a bit more risk averse, but there are different risk profiles across this entire industry, and some people like that volatility because they think it opens up opportunities for them. So, you know, it's going to be a finely balanced approach to how we deal with that.
Okay, we've got a quick question on fixed costs, and then I'm going to call on you, Rohit, just to introduce us to volatility so we can get that side of the segment going.
Hello, Rob Halliday, running Cornish Valley Farming as a first-generation farmer in Cornwall. We're farming 500 acres of beef and sheep in tenancies, contract farming, share farming, and we're also agricultural contractors. And the big problem I have with costings is how I allocate my fixed costs without it becoming a huge paperwork exercise. Do you have any tips, please?
I mean, yeah, as a farmer, I can come back to that. I've been very fortunate. During my graduate scheme, I worked for a fresh produce company and a massive asparagus grower. And every single day, the cost of the harvest was emailed around the business, and we knew the quality of the produce, and we were looking at weather forecasts as well and predicting yields. Now, we're nowhere near that with our farming business, I can tell you that. But they knew the KPIs of that business every single day, and I think that was so important. It just showed where they are, and actually they were an integrated business as well with the consumers, with the customer as well. But I think the main thing is focus on, it's the enterprise costing as well, and I think we just need to use technologies to help us. And yeah, again, I haven't got an exact solution for you, but I think the potentials are there.
I think one of the things you've probably got to look at is just how important it is to be 100% accurate, because if you're not careful, you could spend a huge amount of time trying to work that out and actually not add any value to your business. So it might be better off knowing all your variable costs exactly, but then looking at your fixed costs there, knowing your running costs of the machines, but actually just saying, well, this enterprise is responsible for 30%, that enterprise 40%, and just divvy it out as best as you think you can, because it really depends exactly how finely balanced everything is, and you know, whether it's a sort of a tipping point or not, whether the decisions you're looking to make. But yeah, unless you think it's going to really add to your bottom line, then there does come a point where you've got to focus on the work that you're doing and bringing money in.
Okay, Rohit, do you want to just take us into volatility, and then we'll try and pick up Jeremy and the others that we identified, yeah?
Sure. So probably one area we've talked a bit about volatility already, and we've talked around the role of futures market. So, but I guess one of the areas which causes a bit of confusion is about the work around insurance. So it's probably a good forum to talk about what's going on there. And well, a lot of this work started from when, before Brexit, but it was kind of catalysed by when Farming Minister George Eustice became quite keen on insurance. So we said, right, we need to go have a closer look at this. So we did a trip to the US and Canada, spoke to a lot of organisations out there and farmers to try and understand how it works. But the point is, in our volatility paper, we talk about the piloting of insurance schemes, and the reason for that is not because we advocate insurance as a solution, it's because we feel like it needs to be interrogated to ensure we understand the pitfalls and the potential of the solution in this future world. Now, we hear all the talk about how direct support might change, and we need to think of systems that can come in place to effectively support the industry. And so the question around insurance is, we've done a modelling exercise, we worked closely with the insurers, we've had a roundtable with reinsurers and DEFRA and many individuals to look at, okay, what would revenue insurance look like? How can a farmer protect themselves with, say, subsidised insurance, not like the US or Canada, because we're not the US or Canada, but in the UK, and how would that work? So what we've done is some modelling around feed wheat, for example, just to start with something which has good data, because we do lack the data, as I made the point earlier, and you start to answer some of the questions. So one of the things we do know is that where there's this view that it will cost billions to deliver an insurance scheme, we know now actually the modelling suggests it could be a lot cheaper than that. It could be in the 70 to 100 million mark to deliver a food insurance. For a farmer, it could cost somewhere around 4% of output to get that, or it could equate to, and those kind of answers we're starting to get. But the other thing is we say, okay, all well and good, we're looking at insurance, but insurance would never work on a scale without government subsidy. So one of the conversations we can have off the back of this with the private sector and with the government is that is a public purse willing to subsidise insurance to make it useful or affordable for farmers. And that's part of the conversations we're having as well with government. And I think actually it's probably a good point to bring in Jeremy Diston, who's been helping us just to understand actually what is the potential from a commercial perspective. So Jeremy, would you like to say a few things?
Thanks, Rohit. My name's Jeremy Diston. I work for NFU Mutual, and one of the things I actually do for NFU Mutual is manage its volatility by sharing risk around the globe. So I have been working with Rohit, doing some feasibility studies on really initially trying to understand, well, if insurance products are well developed to help farmers manage volatility in both developed and developing territories, why hasn't that happened in the UK? And there was a theory that it was a supply side problem. So insurers, the suggestion was, didn't have the appetite to help farmers manage that risk. And actually, I don't think that is the case. I'm in contact with a number of global agricultural insurers, reinsurers, and there absolutely is capital available to support farming through managing volatility. But really, I think in a nutshell, Rohit's hit on it. The modelling work that we've done suggests that the potential return available to the global insurance market isn't necessarily sufficient to bring products to the market that, bluntly, farmers could afford to buy. All of the global schemes are some form of public-private partnership. And that's really where the debate has focused at the moment is, could we put together an effective public-private partnership in the UK? And as I say, there seems to be global appetite to help that happen.
And I guess just to build on that, it's not just about, thanks for that, Jeremy, it's not just about public-private partnerships. I mean, that's where we see when we've looked at it, that's where we see scalable solutions, industry-wide solutions to help farmers manage risk. So what you would effectively do, it's almost like car insurance. You would pay a premium in line with your farm, and then that would protect you against any significant losses from any market downturns. That's the idea, for a proportion of your production. So there is some measures to make sure you get out of bed in the morning, for example, because if it's all insured, why would you bother? But but the point is there's a balance to this, and these are the questions we're answering. But I guess it might be a good place to bring Richard Counsell in. So there are some...
Can I just overrule you as chairman?
Oh, okay, sorry, Chairman.
Because I was thinking we might just bring in Maggie Charnley.
Oh, yeah, that's a good idea.
Who's... did I get this right? Head of Farming Risk Management at DEFRA. We must have, DEFRA mentioned. Yeah. And I think it was the point that Jeremy made about the public-private sort of partnership. And I suppose the question of DEFRA is, will it put its money where its mouth is?
Now there's a question. So to borrow a turn of phrase from the Secretary of State, we hope to be able to say more on this shortly. Yeah, no, seriously though. So I think the Secretary of State outlined DEFRA's vision clearly this morning, that we see a move away from direct payments towards payment for public goods, but also really supplemented by that support for productivity. And all of the speakers, and indeed the questions from the audience, have put some of the solutions on the table much better than I can, those things around collaboration and access to finance, investment, R&D. But in terms of insurance specifically, Jeremy's right, we've been conducting some discussions with the insurance industry too, and absolutely the message coming back is there are really no showstoppers in terms of insurance agricultural insurance provision in the UK beyond demand. So one of the things we're doing in the very short term is running some research to look at behavioural and insights and why it is that farmers don't buy insurance currently. And there can be really good reasons for that, because actually farmers have a lot of risk management, on-farm risk management available to them, including things like diversification, which a couple of the speakers have mentioned. And it may be that actually insurance isn't particularly part of the toolkit that farmers want to use, but it's also possible that it's too complex, it's too expensive, it's not clear where it fits in the business plan. Direct payments have been used instead of insurance. There's a whole bunch of reasons. So we're doing some research which will report in April, May this year, looking at some of those kind of rationales. Rohit and I have been talking quite regularly. We don't currently have any plans to provide a subsidised insurance scheme, but depending on what information comes back both from our discussions with the insurance industry and with the farmer-led research, we're open to looking at how some of those tools might be made available. Because I think the important thing from DEFRA's perspective is that farmers have access to the tools they need to be able to manage their income volatility. There isn't a straightforward answer, but definitely we'll want to keep working with Rohit and his colleagues on the kind of things we might want to pilot as things move forwards. And the other thing I was just going to throw in there is we're also going to keep under review the tools that government currently uses to intervene following a really significant crisis. Because at the moment, most of those tools are EU-driven. So there's obviously an opportunity for the UK to say, well, actually, is what we do in this space after we've left the same, something different? Is it providing the right kind of targeted support? But those are the kind of really rare exceptions where the whole, as I think Rohit said, the whole industry is hit.
So as an arable farmer, I mean, we have access to a futures market, and that generally is something that we can use to manage our risk to a certain degree if we decide we want to use it. But one of the things that I'd like to ask John is about the liquidity of that marketplace, particularly LIFI, because if we're going to start using it as a risk management tool, we need to make sure it's a liquid market, which we're seeing reasonably frequently now that it doesn't appear to be that liquid.
And just on that, do you mind saying a few words about the tariff barriers and what complications could arise because of that in the future?
LIFI has become a little bit less liquid over the last number of years, and part of that we think is due to less overall exports of UK feed wheat, and the kind of the knock-on effect for natural end users, natural buyers coming into the market to provide liquidity there. With that kind of less overall exports, with the increase in the biofuel industry in the UK as well, we've also seen kind of more of a divergence between the UK market and the European market. So when we had the two markets which were a little bit more in parallel, they were able to trade off against each other. So the Paris market was able to provide liquidity into the LIFI market, which we're not able to do as much of anymore, because the basis risk there, the spread between the two, has increased. And it brings into it is a really key point. In order for any market to be useful, you need to have the liquidity there for it to be able to access it when you need to access it. So the more tariff barriers separating the UK from Europe increasingly, or kind of more of a divergence there, will make liquidity there more difficult going forward as well, potentially.
Yeah, and I guess this is one of the key issues. When we speak to a lot of farmers in the arable sector, they do say, look, we have the futures market, but I think there's a key message here that actually the futures market is vulnerable to future trading relationships, because many of these futures markets that do have liquidity, or a lot of these futures markets generally, are based in the EU. And so if we did in the future have any tariff barriers, it would undermine the ability of our domestic farmers or the supply chain to utilise some of these markets. And it's something we need to be live to, and this is why we are looking at options such as insurance and how futures can be supported in the long term. So.
Are there any other tools that you can tell the audience about that might be coming on the scene anytime soon to help?
As in different types of futures contracts, etc.?
Yeah, anything.
Nothing I can talk about directly at the moment, I'm afraid, at this stage.
Probably next week.
Okay, just one other question while I'm trying to remember, Rohit, who you wanted to bring in. As a farmer, I mean, where's the best place to go for advice on using some of these tools that a lot of people in the room would be, I would think, naturally quite wary of? Is it a banker? Is it a ordinary? No, sorry, I don't mean ordinary agricultural consultant. But where do you go?
As an arable farmer, there are a few trading companies who offer training courses. So, I did a futures course so that I understood the futures market, and it was a 4-day training course. It was a company offering ODA agriculture, and I think that CRM offer them as well. So there are, for the arable sector, there are opportunities out there, and again, it comes back to this training thing. There are people out there that are trying to help us, and the opportunities are there for us to learn.
Thank you.
And just on that as well, it doesn't necessarily mean that if you're an arable farmer, you need to trade futures directly yourself. You may be going to your feed buyer,
exactly.
and they're effectively doing it on your behalf. You're just going to them, can you give me a fixed price for 1,000 tons of wheat or 100 tons of wheat? So there's different levels of understanding and training that can happen there, all the way up to understanding exactly how the contracts work, to just basically going, can you give me a price, and are you happy or not with that price?
Thanks, Ray. My name's Richard Council. I'm a Somerset farmer. Sorry. Brief, yes, I'll be brief. I'm a Somerset farmer, and I've spent a lifetime in finance and software in Chicago. And we've been working very closely with AHDB and the NFU to try and come up with a very simple crop insurance solution. We've been working on it for 3 years with 4 different universities. And I learned from doing a Nuffield scholarship like Tom, and I became fascinated by crop insurance and its ability to simplify, to make risk management simple and affordable for family farms. And that's what we focused on. It's taken us 3 years, but it's called Stable, and we're pretty optimistic we're going to be able to launch it later this year. So if you'd like to find out, or even better, get involved and tell us what you think, we'd be very pleased to hear from you.
Thank you very much indeed. I'm not going to go to the Surrey farmer down the front, but he did say as a beef and sheep farmer, he was pretty limited in terms of where to go with income to the business, so diversification is key to him. Is that a reasonable summary? There wasn't a question in there, was it?
The question is to say, as a beef and sheep farmer, there aren't many other than a line contract. There are no futures options, it's very limited. So really, for me, resilience, and for every other beef and sheep farmer in this room, is about optimising asset diversification if there are no other tools.
Thank you. Everyone, I hope, heard that. Anyone on the panel want to just come back on that?
Yeah. I suppose just on that, and it kind of clicks in where Rohit's point there on information and transparency. In order for futures markets to exist, you need to have one of 2 options: a physically delivered contract, so the likes of Liffey or Matif, or you need to have a cash settled contract that requires trusted indices. And for that, you need to have strong market transparency, preferably something close to a mandatory price reporting scheme. So in a situation where you can have very strong price reporting, very strong public information, it is possible to build futures contracts or financial contracts on top of that.
Thank you. Right, I think, ladies and gentlemen, I'm going to call the proceedings to a halt. Several of the panel members said, be prepared to identify your weaknesses. Well, I've actually identified a weakness of mine, and that is summarising sessions like this. So I'm not planning to do that, because I also did the silly thing of running around with the microphone. It's quite good to take a few pounds off before dinner tonight. However, I've made no notes. So, unless anyone else on the panel would like to sum up, I mean, there are things. I mean, you're all intelligent people, so you take away what you want from this session. So, I'd just like to, in closing the session, thank the panel very much indeed. I think they've been fantastic in giving you very honest answers to your questions and giving insight from their own businesses or their organisations that they work for. I'd like to personally thank Rohit, Anand, and Amy. The amount of planning that goes into these sessions, you wouldn't believe. I hope you don't think it was 2-stage managed, but we did have a few plants in the audience that we needed to keep the thing going. So that just remains for me to say thank you to the audience, and thank you very much indeed. A round of applause for the speakers.